Okay, welcome everybody. This is number 12 in our webinar series that we've been running since the beginning of the COVID-19 outbreak, and great to see lots of you on the call today. So today we're covering the topic of bounce back loans and cash flow management. So we'll be hearing shortly from John and Ravi, both partners at Acuity. And we'll begin with a presentation from John on the bounce back loan scheme and then move on to Ravi afterwards. And after the bounce back loans, we'll take some questions and then we'll take more questions at the end of the webinar. Please send in any questions you have using the Q&A section at the bottom of your screen, and we'll also be covering the pre-submitted questions. And the last point to mention is that the slides and the webinar recording will all be sent to you this afternoon, along with information about the upcoming webinars that we're running for you. So I'll hand over to John.
Thank you, Rosie. So welcome again this afternoon to, I think it's the 6th week of lockdown, and another Tuesday update looking at what Rishi is offering us this week to help support our businesses. Now, it's been a really encouraging week talking to a lot of our clients, a lot of people on the call today, and getting a good understanding of how successful a lot of you have been in implementing your lockdown strategy, your business preservation strategies. We've seen a great deal of some very good cash planning, some good capital raising going on, great use of the government schemes. We've seen over 200, I think over 200 of our clients access the furlough scheme and access their grants, and more than that doing that themselves. So, and amongst all that, some really good entrepreneurial ideas to keep generating revenue in your businesses, which is really, really good to see. And then we had last week Rishi pop up to talk about yet another scheme that we've got access to, which we're going to focus on predominantly today. This was a mixed, a lot of questions that we're getting from our clients around, what about me? I'm a really small business. What about me? I can't access these loans. There doesn't seem to be anything for me out there. This, we think, really answers a lot of those questions and provides you probably with the support you need to get through the next quarter or so. We're also going to spend a bit of time today where Ravi's going to just help us understand, I think, some of the top 10 advisory pieces that he's working with clients on cash flow topics to do. We're still getting a lot of helps and hands up from clients talking, asking for help around, you know, I've got some of the support I need, but I really can't manage my cash flow. The cash still seems in crisis. So Ravi's going to very quickly unpack some of the top 10 things that he sees that are good for us to hear today in our businesses. So let's kick on with this then. So the bounce back loan scheme. So we learned last week that Rishi had decided that it was worth the government providing 100% guarantee for a certain type of loan out to businesses. And what we were seeing in the market, that the stabilise scheme just wasn't really serving well the smaller end. We kept hearing time and time again, I'm trying to access a £5 loan, a 25 grand loan, etc. And either the application being too complicated or the process taking too long, that businesses are giving up on the process. So this is what then should hopefully fill that gap and accelerate getting money from the banks to the businesses that much need it. So let's just have a quick through about what we know now. So the first thing is the scheme is currently open. So there may be some of you out there who've made your applications who know more than us about the application scheme. So please do share your experiences with us on the call today. It'd be great as well if people have had some successful applications already to share their experience with the rest of the audience here would be great. But also just let your partners and client managers know where you're successfully getting these applications in. But what do we know technically what's going on? So first of all, any business can apply to this. So it doesn't seem like there is a cap at the moment in terms of size of business, but certainly any business size-wise on this call today will be able to make this application. Entity-wise, limited companies, LLPs, sole traders, partnerships, you can all apply, but you must be undertaking a trade. The loans are going to be sized as a maximum of £50,000. But it will be limited to 25% of your turnover. Now the turnover figures, it does seem a bit vague of what the number they'll take. We've seen on the HSBC application process, it's your 2019 number. So we're not sure yet whether that's submitted accounts or sort of management accounts looking at rolling period there. I'm sure we'll learn in time as more applications are made. This is going to be a 6-year loan, so a very long-term loan. The government are going to cover all interest in the first 12 months, and there's going to be no capital payments in the first 12 months. And for the remaining period of the loan, we expect the interest rate to be 2.5%. So just to repeat that, you're going to have a 6-year loan, no capital repayments in the first year, no interest payments in the first year, and 2.5% for the remaining period. There is no other point in time in history, famous last words, that you'll be offered loans this cheaply. Okay, so this is a fantastic product for small businesses. And one of the crucial parts here is it appears that the application process is genuinely as simple as Rishi said it would be. So a 7-question self-certification test that you should be able to get through without any advisor help. So this is something you should be trying to do yourself before trying to get us to support you in doing that. And apparently, we're still early doors yet, once you've successfully completed your application, funds will be with you within 24 hours. So again, if anyone on this call have made an application yesterday and received funds today, it would be great to hear that. We're aware of a few of our clients who've already gone ahead and done that, but we're yet to see any funds hit client accounts yet. Our expectation that I think we talked about last week is we thought the process might take 10 days all in all from start to finish. It could take a lot shorter. Seeing some of these applications, and we've been trying to kind of get on the various lenders' websites to run through these application forms. It does genuinely seem like it will be a very quick process. Okay. So the scheme did open yesterday, so at 9 a.m. And a really interesting statistic here for those who like these sort of numbers. There were 100,000 applications received yesterday for the BBLS, the Bounce Back Loan Scheme, and I think this is more than twice that have applied for the stabilise scheme. I think I've got some data further on, but look at that. But it's in one day alone, there's been more applications for the Bounce Back Loan Scheme than for the stabilise loan scheme, which demonstrates how much in need this particular product has been. Right, so just kind of just back into some of the detail here, or the detail that we're aware of, both looking at the application forms that we've been able to access, talking to bankers and the like, and also obviously scouring through the government documents. So when you make your application, you're going to go through a self-certification process, and I think a lot of you who got mortgages perhaps 10+ years ago were very used to this self-certification process, which was very quickly outlawed as part of banking process, but it's back. So you've got to certify that, first of all, you've been impacted by the COVID-19 pandemic. It doesn't look like you have to provide any sort of narrative, which we have seen with stabilise loans. You just have to certify that, yes, we've been impacted by the pandemic. You have to certify that you're not a business in difficulty, and we'll unpack this little phrase in a few moments, because it is actually very important. But you must certify that to do with your balance sheet and whether you're in an insolvency process or not. Clearly, you've got to be undertaking commercial activity in the UK. You've got to have been established before March 21st. And quite importantly, you cannot currently have a stabilise loan in place unless your stabilise loan is under £50,000 or £50,000 and under. And in that case, it looks like you will be able to convert that stabilise loan to a bounce back loan. So this deals with the cases where those of you who have managed to get a small loan under the stabilise scheme are now looking at this loan product going, hey, that's cheaper, it's less capital payments, it goes on longer, why can't I access that? So the government have thought about that and said you can refinance your stabilise loan into a bounce back loan as long as you would otherwise qualify for the bounce back loan. If you do have a stabilise loan in place that is above this at that point, so £60,000, £100,000 upwards, you won't be able to access this scheme alongside. But presumably you might not need to at this point. It also, we've had a few questions around, I'm in the process of applying for a stabilise loan, or I've actually made an application for a stabilise loan. Our understanding at the moment is that you are fine. You can still make your bounce back loan application as long as you haven't accepted an offer from your bank for the stabilise loan, you're fine. So you can still make applications under both schemes, just don't accept your stabilise loan, don't sign your documents and draw down your loan if you want to get the bounce back loan. Another important point to do at this point around where you derive income from. Okay, so again, as we expected, a lot of our landlord and investment type clients have asked, can I access this scheme? So the scheme is for trading businesses. So the rule is that you must derive at least half of your income from a trading activity, which doesn't, a buy to let doesn't count as a trading activity, in order to be able to access the scheme. So it's not going to be funds to be used for buy to lets. There's a number of restricted sectors, of course, banks, building societies, etc., but I don't think any of those industries are covered on the call here. Who's lending? So there are over 50, perhaps nearly 60 lenders now, I think, on the stabilise scheme. Not all of those will be offering the lending under the bounce back loan scheme, so it'll be a smaller subset. It does seem like in the last 24 hours, 1 or 2 more people have been added to this list, but the main banks are all here. Now, if one of these NatWest, Barclays, etc., are one of your banks, you should be making an application to them directly. Now, if your bank is not represented here, you have a few options. You could wait to see or talk to them and find out if they will eventually be represented and hold out and make your application then, or you can start an application with one of these banks here. I'm not currently aware of any criteria that you must have a loan, a current account currently open with one of these banks. We have seen that requirement under the stabilise loan scheme. Not sure if it's going to be reflected here. If it is, so let's say if Barclays do require you to have a current account in order to make the loan application, you must then make sure you plan to provide a lot more time in place to get hold of your loan, as current accounts can take quite some time to open, as banks are struggling with getting resource to actually work on this stuff, to open accounts, but also because banks are such large know your client type KYC rules they've got to follow, collecting passports and all this sort of stuff. So just taking a few moments to look at this business in difficulty statement, as it is relatively technical when you start looking at some of the legislation behind it. The British Business Bank have laid out some normal plain English points here, which we'll pull apart now. So the first point is you must not be in any sort of formal insolvency process. Okay, so that's, you're not in a liquidation, you're not in a CVA, you're not in administration, etc. If you're in one of those processes, you can't access this, and you're unlikely to be wanting to access this in any way. Your business has probably stopped trading if it's an insolvency process. Now, the important part is here for a limited company, your accumulated losses. So if you've had a number of years where you've been accumulated losses, and those losses on your balance sheet are showing as negative profits brought forward in your capital account, or your capital part of your equity part of your balance sheet. If those are greater than half of your non-distributable share capital, so the money that either the shareholders have invested into the business or just the nominal amount of the shares, by the shares that they hold in that. If the losses are greater than half of that value, then you are now defined as a business in difficulty. Now, we think a lot of businesses will be caught in this. For example, if you have funded your business using director loan accounts, you have these huge liabilities sitting in your balance sheets owing back to the directors, and you haven't funded it via equity, you quite often will then have a balance sheet which shows that you have got a negative reserves. Okay, so you've got a negative balance sheet because the amounts are owed back to your directors. In those cases, as long as you were less than 3 years old, just to reiterate here, if you're under 3 years old, this rule does not apply to you. But if you're over 3 years old and your balance sheet is negative, you will be a business in difficulty. Okay, so it's good to have a look at this. It is, I think, I won't take it for granted of how technical that might be. So do talk to your client manager or partner, your usual contact, to have a look at your balance sheet to see if that does apply. Okay. The similar rules apply from partnership, but it'll be looking at your capital accounts rather than your distributable share capital. A really key point here is, as we're kind of learning this morning, is that if you are a business in difficulty, it appears that it doesn't necessarily disqualify you from being able to access this. It just will likely mean that you may need to talk to the bank, or they need to talk to you to understand the situation you're in. And you may have additional terms applied to your loans, but we don't know a lot about that at the moment. I suspect that what they'll be checking is, okay, so why are you in negative reserves? And it could be that, oh, we've decided to finance our business using director loans instead, but otherwise we're trading fine, we've got a good P&L, we're showing we're making profit now going forward, and that might be enough. We don't know yet. So again, if some of you have this experience in making these loans, of receiving these loans, and you have ticked the box saying that you're a business in difficulty under this definition, let us know what happened with your loan. Okay. Okay, so storming through some FAQs, as we've had picking up some of the questions that we've already had in so far. So can I pay the loan before the full 6 years? Yep, sure. So you'll remember in the first year, there will be no capital repayments on the loan, and the interest is being paid for you. So I wouldn't recommend repaying it in the first 6 months. But obviously after that period, you're starting to pay interest on the loan, and you will be paying capital repayments like on a monthly basis after that. If you want to clear it very quickly after that, you can. There's no early repayment fees. Can I pay dividends out while having the loan in place? So we're not aware of any, and actually the government have reiterated this in a Q&A with them, that while you have a bounce back loan in place, as long as you have distributable reserves to pay dividends, you can continue to do that. There's nothing stopping you distribute profit to shareholders while having the loan for. What can I use the loan for? Now, quite clearly the loan has been or the product has been developed for business to help businesses trade and to increase their trade, to bounce back from the economic decline that we're in at the moment. So it's not for personal purposes. So I mean, this will be self-certified, so you will be certifying that you're not going to use it for personal purposes. Whether this will be audited or checked at some point in the future, who knows? But the purpose of the loan, as stated in the legislation or in the government guidance, is it's not to be put into a business and immediately extracted for personal purposes. Okay, so that's really the bounce back loan. It's worth just doing a quick comparison to the stabilise loan, just so we're clear of or helping you get a bit clear about which direction you should be possibly going as a business. So the first point is, remember that the stabilise loans are for up to 5 million loan size. So if you're a larger business and you require more than £50,000, clearly the bounce back loan is not going to be for you. Okay, and remember, you can't apply for both. You can't get your 50 grand bounce back loan in and then go and get your £500,000 loan in, which really shores up your working capital. You can only do one or the other. The stabilise, remember, on the stabilise process is much more complicated than the bounce back loan process. So we've been helping quite a few clients now, so working with a good number of you to get your applications in place, to reach the right lenders, talk to the right lenders. And all of these applications have included cash flow forecasts, and in the bigger ones, P&L on balance sheet, cash flow forecasts as well. So it's a more difficult application and a longer application to make. The loans are generally more expensive, but not by a lot. So we're seeing a lot of the high street banks offering terms of between 3.5% to 4%, which is still, and 12-month interest free, which is still ridiculously cheap. You will, again, I'll probably eat my words, but you won't find debt cheaper than this again. I mean, until the next pandemic potentially, but this is you know, we're normally seeing for an unsecured loan in an SME either very late single figures or early double figures at least. You know, a funding circle loan will often be between 7 to 12% for most businesses. We've seen a lot of applications go in to for these civil loans. 52,000 applications have gone in, but only about 28,000 are still awaiting decisions. So we can see that it does take longer to get your civils loan. So you must appreciate that when deciding what do I need to go for. Perhaps if you did need 80 grand, but you needed it really quickly, you should potentially be thinking about, I can get my 50 quickly and I'll have to make do without the rest. Okay. All right, so before we just move on into just trying to unpack some of these cash flow strategies to go with, you know, the lending that we get access to now, Rosie, are there any particular questions that we want to pull out that we can quickly get through over a few minutes?
Yeah, there's just a couple I think we can take at the moment, John. So we had a pre-submitted question from Peter Lambert, who was asking how long will this loan scheme run for? Okay,
great. So I think the period is going to be open for the same as the stabilise schemes, around 6 months or so. I don't know if there's a definite date yet, and in the background, if one of my team can just confirm that for me, that'd be great. But yes, so assume it's 6 months, the same as stabilise. So if you need to make the application, make it now, I'd say. But you have got time to do it. You don't have to rush into doing it straight away. So I think it's 4th of November is the date when the scheme is going to close, which is yeah, sooner than I thought.
Excellent. And one more pre-submitted question from Dawn Garnham Wilkinson, who was asking that she's with the Allied Irish Bank and they're not on the list of lenders at the moment. So what should she do?
Okay, and just did Allied Irish come in at the last minute? No, they haven't. I think, as I mentioned a bit previously there, if your bank is not, if you don't currently bank with one of the accredited lenders, you will have to approach someone who's not your current banking partner, which may mean you have to open a current account. So it will take longer if you have to do that. But my suggestion is, it seems very straightforward to make these applications. So just if you go to the British Business Bank, or you just Google any of the bounce back loans for any of those HSBC, Barclays, etc., you'll very quickly get to an application form. Have a go at filling that out and seeing how you get. It certainly won't. There's certainly no rules or legislation of why you can't take a loan from another bank if you don't have your current account with them. There's no reason why you can't do that. Okay.
Okay, great. And we had a question from Claire Barrett, who is in the middle of her CBILS application. So she's considering, should she stop that and do the bounce back loan scheme, or should she continue with the CBILS and as a top up for the bounce back loan? And her application is for 80,000.
80,000. Okay, so if you need £80,000 in your business and nothing less will work, then you need to continue with your CBILS loan. Okay, so remember that you can't have a CBILS loan and a bounce back loan together. You can have one or the other. If you've already made your CBILS loan for £50,000 or under, you can look to get that refinanced or converted into a bounce back loan. Okay, but if you're in the process of making your CBILS loan and you haven't accepted an offer from a bank yet, you're still at a stage where you can stop the application and switch to your bounce back loan. If you need the money really quickly, I'd suggest switching to your bounce back loan, and you'll get that. Hopefully, it does look like you could get it within days.
Okay, and then the last area, John, is the landlords that we've got on the call. So just a couple of questions there around, are they eligible if they're buy to let? If they're not, what other loans should they be applying for?
So the rule that was put in place along with bounce back loans is that 50% of your derived income in your business must be from trading activities, not investment activities. And we know that buy to let as an activity is an investment activity. So if you've got a buy to let entity, you won't qualify for these loans. Okay, and we know from looking at lots of these schemes out there and the rest, there isn't any major government initiative that supports buy to let investors. You'll be having to look at your own banks for support, and then so we know, as Simon Howard has been on a few times to talk about what he's seeing across our portfolios, and him seeing personally as a buy-to-let investor, is they're seeing a lot of the banks are cooperating quite well with buy-to-let businesses, pausing interest payments, having them rolled up and paid over the rest of the term of the loan. And we know that if you've got commercial property, potentially with a tenant who's gone bust during the period, you could have your rates paid for by the local authority as well. So there are a few things out there, but broadly these sort of loans, CBILS included, are not for investment companies.
Okay,
and so reach out to your current lender.
And one more quick one before we move on to Ravi, John. Is Starling Bank on the accredited list?
It's a good question. So I've just had some information in on that. So Starling Bank are not yet accepting applications, but the website says they're hoping to offer them soon.
Okay.
So we don't know what hoping means. Now, we've seen the government turn around quite quickly where they've been bringing CBILS lenders into accreditation. So I think keep an eye on it. Okay,
that's all for now.
Great. All right. So Ravi, it'd be good to hear from you then around the sort of top 10 strategies that you're talking to clients about at the moment.
Sure, sounds great. So as John, as you mentioned earlier, we tend to work through about 10 key points in our cash flow healthcare routine with clients. Now, what we're hoping is that not all of these will be applicable, but hopefully one or two of them might be useful for each of you out there. So the first three are focused on inventory, payables, and receivables. So with inventory, it's really clear. It's all about being really concise in your planning. So if you're not expecting too much activity in the immediate term because of the pandemic, then even if you do a very simple assessment of your stock levels, looking to identify how can we release some cash from it. Whereas if you're still expecting to deliver on your stock items to customers, despite the pandemic, it's been really clear, okay, by when at the latest time I need to get some stock in. But effectively, if you're not expecting to deliver much, it's really taking a look at your stock to see how can we release some cash from it to help the cash flow. Secondly, payables, we all know this one, but it's really important that we identify how can we work with our suppliers to ease our cash flow burden rather than maybe just having an approach of cutting them off entirely, because we've got to come out of this at some point and we'll need them to trade with. Mm-hmm. And then with receivables, one of the things that we've been working on quite closely, and this is the pandemic, it's important for any kind of crisis situation, is having a customer specific approach. So you're saying, okay, well, how can I come up with a payment plan for that particular customer? Because actually having your money come in drips and drabs from now is better than potentially getting all of it in the future, because you don't know what the future holds. So then the fourth point is looking at your fixed costs across the business and understanding how can I turn these into variable costs. So an example would be if you own some machinery, you could approach some lenders to do a sale and lease back. So you'd sell the machinery to them and lease it back from them. This would release large lump sums of cash into your business, depending on the type of machinery. You could also look to do this around stock and receivables, which we cover in the next point. But effectively looking at your business and saying, okay, if I was really pushed to, how can I take some of these fixed costs and make them variable so that as my business grows and expands like a balloon, those costs grow with them. But as my business shrinks with the air coming out of the balloon, my costs shrink with them. So it helps through this period. Now, we've talked a lot about the government support via CBILS and the business bounce back loan, but actually there are lenders out there who are providing invoice discounting facilities, who are providing construction financing. And so it's really important to understand, okay, well, I've got a pretty decent receivables ledger with some pretty strong clients. Why don't I start speaking to a lender to see if I can finance those receivables to start getting some cash in? And there are lenders out there who are in the asset finance world who are still having that approach and still doing those kinds of loans.
That's a really good point, Ravi. Actually, what we quite commonly see across clients is a massive underuse of non-term loan type financing arrangements where they haven't considered the other options other than going to the bank and getting an overdraft or getting a term loan. And the one in particular, which I think has improved so much over the last maybe 3 years in the SME space, is invoice financing. There are some really well thought through technology-driven invoice financing products now that you can get hold of and use to release money from invoices that you didn't even think were particularly maybe that strong of an invoice out there. So you don't have to be trading with blue chip clients in order to get a good invoice financing discount, and also to be able to get a really flexible invoice financing discount. Because one of the misconceptions about invoice financing is that, well, I've got to put my whole ledger in, all my invoices must go through, and then it's too expensive, then I only want to put these 3 in. So there are plenty of products out there. Market Invoice is a really good one. We've had loads of success of getting clients onto that platform and using Market Invoice, where effectively they trade your invoices with hedge funds and other investors in the background. You don't even see any of it, to be able to release money from your invoices. So it's really good to think about that. You know, it's CBILS and bounce back loans are not the only loans out there. You can get other stuff out there.
Exactly. And just before we move on to the next slide, I think that the key points, the key thing I stress about these points are that although we tend to think about them on a day-to-day basis, actually focusing on some specific time on each can really bring some benefit to your cash flow. And it's in a time like now, it's very easy to say, oh, my fixed costs are my fixed costs. But actually, everyone's having to adapt at the moment. So there are some more options available, whether it be through financing or other means.
Yeah, great. Well, so before we move on, I just want to make a point around those first 3 parts about inventory, payables and receivables. Now, often the case with when you look at those 3 areas, it's the accumulation of lots of little things that you can do that make a big difference. And a few weeks ago, when we talked through one of our cash flow management tools and basically looking at how we might pick apart and run a 13-week cash flow for just an example demo client, we were showing you how a multitude across maybe doing a deal with that supplier, stretching the term out there, but getting this customer who can't pay at least getting a third in now, releasing some money from inventory by reducing the price of a particular product or what have you. How all those added together actually gets you through the low dip that you thought that you can get through, or those items in addition with a £50,000 bounce back loan gets you through that dip up to where you think your consumer demand is coming back, or that new contract is due, that was delayed is due to start again in the future. So it just highlights the importance of the cash flow management aspect, which is getting onto a cash flow spreadsheet or whatever tool you want to use and adding up these little changes that you can make.
Exactly. And I think, just in those areas alone, you can create as much value as you would do through a grant you might not have got, or through a civil zone you might not get. Mm-hmm. So the next point is, although it seems relatively straightforward, actually the amount of times we've been in with businesses and we've noticed, you realise that this customer is actually applying a discount where they shouldn't be, or do you realise you pay a bit more with that supplier? All of those little bits add up, especially in a period right now. So taking some time to really look through your payables and receivables to make sure they are as they're meant to be, and not just assuming they're correct, is really important.
And also there, just to butt in again, sorry Ravi, is that audit your revenue, your billables, to the point of, are you actually, so forget the stuff that you have invoiced, audit that for sure, but are you actually invoicing for everything you should? It's the amount of case studies we've got where we've gone into businesses to do a cash flow crisis type piece, and we've solved the problem by highlighting that you haven't billed 100 grand of the revenue that you should have billed over the last year because you forgot to bill this, attach this particular product onto to an invoice, or a 10% of the invoice was paid by another party because some party paid this. You never chased that part. Make sure you are billing everything that you can bill, or you think that you are billing, because it's not always the case.
Exactly. And these are all things that are important to get a habit into. And actually now's the best time to get yourself into a habit of looking at all of these things, so that when we come out of this, your business is doing the right things at the right time. Mm-hmm. So point 7 around the business interruption insurance. Now, I know there are a lot of businesses out there where their insurance policy doesn't cover it. However, we are noting that after the SARS pandemic, some insurance companies are including it in their insurance policies. So it's really worth checking the fine print in your insurance policies as to what it covers, because that can make a big impact right now.
Just to interrupt there again, because I've got something just into point. Sorry, Ravi. On the business interruption insurance, actually, we've had some really good intelligence from behind the scenes around how well what's happening with insurers paying out to clients. So we've got a client who works in this space, and we're hoping to develop some advice actually for the rest of you, and potentially a service for the rest of you to help you make these claims. Okay, but what our inside knowledge is telling us is that insurers are hard fighting paying out business interruption insurance at the moment. So you will probably have, for a lot of cases, you'll probably have to work with a specialist advisor to work through the insurer's objections to your claim. Or we might see a government scheme come out in time where they actually force insurers to pay out. We'll see. But there's some interesting things going on in that space, despite the government saying we've spoken to the insurers and we assure you that the insurance is going to pay out. It's not.
Exactly. So I think then the next 2 points are really tackling the grey matter, and it's kind of thinking outside the box. And so what we're saying is okay, are there any other areas where our product or our service might be useful that we aren't currently already servicing? So we're seeing articles in the news and stories of engineering businesses that are at a moment's notice turning around and providing PPE, or we're seeing technology companies adapt what they provide to help key government services, and so really taking the time to understand, okay, well, I know I've been providing this product or this service to these types of customers for the last little while, but actually, what problem am I solving for them, and who else might have this problem? Asking that question and spending some time thinking about what the answer to that question is could be really important, not just for creating some stability in the immediate term, but actually creating an additional revenue stream once we come out of the pandemic. So then, in terms of thinking outside the box, there are, and this isn't something we see often, but there are some cases, and we have come across them previously, where we're finding that some of our customers some of the customers of our client are in trouble, and so they don't necessarily have the cash to pay us, but actually creating some sort of joint venture with them is more fruitful in the long run. And something like that, whilst might not immediately solve the problem of paying that particular invoice, can provide some cash flow over a medium and longer term period. And so that's something that's often considered when it comes to payables and receivables. And the last thing, and again, John might smile because I'm always going on about this, is constantly making sure that on a weekly basis you're updating your cash flow is really important right now. So the thing about a crisis situation is that it's completely unpredictable. And so going through a process weekly where you're saying, okay, this was my plan for last week. Did it work? Did it not? This is what my cash flow forecast looks like now for the next 13 weeks. What's my plan going to be and what am I checking against? So each week you can see, okay, the things I'm trying at the moment, oh, these have worked, let's keep going with those, and these need a bit of tapering, is really important. So making sure that you're constantly updating your cash flow on a weekly basis is going to make sure that you're taking advantage of all the possible things that are available and all the immediate term wins around your cash flow.
Great. Sage advice, Ravi.
Perfect.
All right. So I think that brings us to an end at the moment of our slide deck, at least. So Rosie, should we move on to doing some Q&A?
Yes, well, actually, John, we've covered most of all the questions. In fact,
Great.
During the first section, if anyone's got any more questions, do send them in. But I think it was very comprehensive what you and Ravi both covered there.
Good. Okay. Well, my only ask of everyone on the call is that when you do make your bounce back loan applications, let us know how you get on, share your experiences, because yeah, we need to collect that information and share it with everyone else as well. Great. Okay. All right. Well, thank you very much for joining today. We'll bring that to a close then Rosie. We'll leave, like we have in our past webinars, we're going to leave a poll open just to collect some really useful information from you, which helps us adapt what we do and we tell you and serve you with. It'd be great if you could take a few moments to do that. Otherwise, we'll likely be joining you again, Ravi and I, next week on Tuesday. Right. Thank you very much, everyone.